Hello everyone, welcome back to the TPM learning series. Today we will be talking about TPM financial layer. In TPM, the financial layer is the engine that converts the promotion into the business outcomes. It connects the commercial team wants to do with the financial team allows to happen. Without this layer, TPM is only operational thing, and with this layer, TPM becomes the strategy. Let's talk about why financial layer exists in TPM. Promotion are not just a giveaway thing, they are the investment. Okay, finance team wants to know how much did we spend, how much did we make, and did we destroy any margin. TPM answers using the ROI, gross to net, and P&L. Let's talk about TPM financial architecture. This architecture shows the closed loop. Customer business plan define the ambitions, promotion gets executed, then Accrual forecasts the cost and the claims. After the claim confirmation, ERP does the settlement kind of thing. That loop keeps the commercial team and financial team aligned. Let's talk about some key finance questions that answered by the TPM. These four questions governs all the TPM. What did we spend? What did we earn? What is profitability? Should we run this next year again? This is the why TPM feeds the RGM team. Let's talk about some promotion P&L component. Promotion P&L breaks down the revenue and spend. What is baseline? Baseline is what would you have been sold without any promotion or any kind of advertisement. Second thing is incremental uplift coming from the promotion, like you are selling 1 lakh unit of something and then you will able to sell 1.20, so that 0.20 is a uplift thing. So trade spend equals to money invested, and net sales equals to revenue after the leakage. Contribution equals to profit, and ROI will be calculated like this: contribution divided by spend. Let's understand this thing by the numerical P&L examples. Let's put the number. Baseline is 10 lakhs, incremental is 3 lakhs, and the trade spend is 2.4 lakhs, and the profit we are getting is 2.8 lakhs. So ROI will be becoming the 2.8 divided by 2.4 equals to 1.17, because we already learned this thing. ROI equals to contribution divided by spend. So anything above 1 is profitable. Let's understand these things by the category wise. So firstly we will be talking about the snack. In snack, during the IPL, volume jumps dramatically, but the deep discount push the ROI below 1. That means growth is happening at the cost of profit. Okay, let's talk about second category, beauty. Beauty behaves opposite. Smaller volume spikes, higher margin, and the ROI often about 2. This finance team loves this kind of promotions. Let's talk about the third part, uh, beverages. So beverages spikes in summer because this is the seasonal kind of thing. Promotion are used to make market the shares, and the margins are moderated, so spend must be the technique and control way. Let's talk about dairy. Dairy adds the perishability risk kind of thing. It execution fails, the spoilage eats the profit, so TPM models waste as part of the ROI. Let's talk about or what is gross to net in the waterfall kind of thing. So gross to net shows how the list price adopts the thoughts and the discountability, rebates, claims, trade spend. Finance uses these track for the leakage as well. Let's talk about GTN in the numerical numbers. Let's take an example. List price is 100 and the TPR is 8 and the claim is 3. Then the net equals to 74, and then in this case we have the 26% of leakage. Let's talk about how things will work. Distributor versus retail GTN. Distributor model includes the margin, volume slabs, and the retailer model includes the scan bags, display fees, that kind of thing. So both hit the net sales differently. Let's talk about this thing in the Indian market context. In India, GT uses the distributor scheme, MT uses the scan based claim. TPM must support both in parallelly for the Indian markets. Let's talk about the incremental volume logic. Incremental volume equals the promotion sales minus the baselines. This drives all financial maths as well. Let's talk about incremental volume example with the numerical numbers. So suppose you have the baseline of 1200 unit and the promotion of 1800 unit. So incremental will be a 600. So lift in this case it will be calculated as a 50%. Let's talk about efficiency versus effectiveness. Efficiency equals to lift and effectiveness equals to lift and the efficiency equals to ROI. Commercial team chase the lifts and the financial team chases the ROI. Let's talk about the trade spend types. So TPM supports the fixed display fees and the variable rates as well, conditional payments as well, and the claim based thingy as well. Let's take an example of trade spend. Like suppose a 5 rupees per case on the 20,000 cases will become 1 lakh and the retail scan bags only 45k. Then the total spend will be a 1.45 lakhs. Okay, let's talk about the claims and the settlement. Claims convert the forecasted spend into the actual payments. This life cycle we already done in the previous videos, so you can watch that video as well. Let's talk about the Accrual true up the example thing. So Accrual predicted 1 lakh rupees, but actually what claims are done 1.12 lakhs. So 12k hits the P&L kind of thing. Let's talk about the finance versus commercial team. Commercial team wants the growth and the financial team wants the margin. TPM balances the both the teams using the numbers. So TPM is very important in this situation to balance out the things. Let's talk about the RGM integration. RGM team analyze. What they analyze, mix, what kind of bundles they can mix, pricing and the promotion roles as well, and packaging strategy, pack kind of strategy they also can monitor or make that thing. Let's talk about TPM plus ERP plus DP. So demand planning sends the baselines and ERP settles the claim and TPM orchestrates everything like what is happening overall. So that is why TPM is required. Let's talk about post event analysis link. PEA validates the following things. First is lift, second profit, and third is repeated decision kind of thing, like we want to do this thing again next year or we want to drop this thing. So these kind of analysis will happen. Let's talk about the finance governance that will be coordinated using the what they will do, budget, how much we will able to spend, the compliances, who will approve the budget and those kind of thing, audit, like where we have spent these budget. So that will be done by the financial team. Let's talk about the enterprises benefit. Using this we will be able to predict the profitability. Predictability will be easy, how much we will able to sell next year. Then the profit focus is also increases, how we will able to gain your profits and loss. If any loss is happening, RGM also enabled in this. Let's talk about TPM financial maturity. What will happen if volume lead, then the profit also lead if we are not selling this thing on the discount. If reactive, we are doing a reactive promotion, like if any kind of event is happening, then we are putting up our promotion, then it will be a strategy kind of thing and it will increase our profitability as well. Let's talk about the final takeaways of this video. So TPM plus finance equals to strategy. Maths beats the intuition every time. Thank you.